Making a lot of money fast out of a little, almost everyone dreams of that. And online, almost everyone promises it too. But the honest answer comes down to a single number that hardly anyone tells you about. It's your starting capital. Because whoever starts with $1,000 has to play completely differently than someone with $1 million. Get that wrong, and you end up losing both, your money and your nerves. Today, I'll show you how I would approach it with a small account and with a large one, from the ETF to the future. On top of that, I'll show you the chessboard method, which lets you spread your risk intelligently. Stick around until the end, because there's an important note about a price change and our summer break. Let's get into it. Disclaimer. Quick heads up. Yes, I'm an AI avatar. Trading Swarm is our English channel. The German original is Kaspareit Trading. We've now made the entire system available in English. The same portfolios, the same approach. As always, this is not investment advice. Trading involves risk. Only trade money you can afford to lose. Money is a means to an end. Let's start with the most important truth. Money is always just a means to an end, and without risk, there is no return. That's not a slogan, it's a law. Whoever wants more return has to carry more risk. It's that simple. Look at the 4 big tools. On one end sits the ETF, broadly diversified, calm, long-term. Then comes the single stock. More opportunity, but also more swing. After that, the CFD. Here you work with leverage, and leverage magnifies gains and losses alike. And at the very end sits the future. Its leverage isn't bigger than a CFD's, you just need more capital. In return, the future is the fairest and easiest to calculate product. It runs directly on the exchange with no market maker in between. So it's basically the cleanest tool of all, but only tradable with a larger account. And now the point many don't want to hear. An ETF is great for protecting wealth long-term and letting it grow slowly. It beats a savings account by a mile. But for building up fast from little capital, it's the wrong tool. It's simply too slow for that. Whoever wants to grow fast has to play further to the right on this spectrum. And that's exactly where the question of starting capital becomes decisive. The loss asymmetry. This isn't only about what you can win. It's above all about what a loss does to you. Imagine you lose $1,000. That hurts. But your life doesn't change because of it. You earn it back. Even $10,000 is survivable if you're young and have time. You start over, and in the end it was just $10,000. Now imagine you lose $100,000, or even $1 million. How heavy that weighs depends on how much you have in total. For a billionaire, even $1 million can be a small amount. But for the vast majority, that's no longer a setback. It's an emotionally defining experience that can follow you for years, and that's something you'd wish on no one. And from that follows a simple rule. Small amounts you may deploy speculatively because a total loss won't destroy your life. Large amounts belong in conservative places because the pain of a big loss is out of all proportion to the possible gain, and so you don't build up false expectations. Here's the honest math. How long does it take to turn $1,000 into $1 million? At the typical ETF return of 7% a year, you'd need around 100 years. At a very strong 15% a year, it's still around 49 years. At an aggressive 30% a year, around 26 years. And even if you could double your money every single year, so 100% a year, it would still be around 10 years. But doubling every year is pure fantasy in the long run. It almost always ends in a total loss. There's no way around that. Fast and safe at the same time doesn't exist. And the odds that you lose that $1,000 are high. So you don't keep starting over at $1,000 again and again. You're better off saving up to $10,000 first, and then you start for real. How that works, I'll show you now. The chessboard method. Now to the method that ties this all together. I call it the chessboard method. And the most important idea behind it isn't turning a little into a lot. The most important idea is not turning a lot back into a little. In chess, every piece has its job, and we carry that exact image over to money. At the very bottom stand the pawns. Those are your high-risk accounts that generate cash flow. In the middle stand bishop, knight, and rook. They run a bit more conservatively than the pawns, but not yet as safe as queen and king. And at the very top stand queen and king. That's your safe capital. Here our large strategy portfolios run in both directions, long and short, but with low risk. That stands for the greatest stability and the greatest safety. And long-term, this part makes up the biggest share. And here an iron law applies. Money only ever flows from the bottom up. The pawns earn, and their gains move up into the safe area. Nothing ever flows back. So the safe core never rescues a fallen pawn. If a pawn dies, the other pawns fill it back up first, before they pass gains upward again. And queen and king don't have to recover a setback alone. They do recover on their own strength. On top of that, they get constant support from the gains flowing up from below. Let's look at it concretely with $10,000. With a small account, you don't build the whole board yet. You start with queen and pawns. $6,000 goes onto a safe core account, your queen. It runs conservatively at a low risk level, for example with our portfolio L, which is very broadly diversified and can also be run at low risk. The remaining $4,000 you spread across 4 pawn accounts of $1,000 each, trading at a clearly higher risk level. Here, you're allowed to be speculative, because every single pawn is allowed to fall. For that, you can use our portfolio S, run at a higher risk level. The mechanism is simple. As soon as a pawn account doubles from $1,000 to $2,000, you shift the $1,000 profit up to your core account. The pawn then keeps running with its original $1,000, but that's just one of several options. With the $1,000 profit, you could just as well start another pawn, which then earns in parallel, or you transfer only half upward. Then you let the pawn keep running with $1,500, but at an adjusted risk level. That way you find the right mix of growth and safety for yourself. And now, stay realistic. You have to firmly count on 2 or 3 of your 4 pawns falling. That's not a mistake, that's planned. Your maximum loss is capped at the $4,000 of play capital, while the $6,000 in the core stays untouched the whole time. What matters here is what exactly sits on the pieces. With us, those are whole strategy portfolios, so several strategies bundled into one package. For small capital, they run on a CFD basis because CFDs suit small accounts and fine risk control. With more capital, stocks and ETFs come in as well. And here lies the real key. It's pointless to put the same strategy portfolio on a pawn and on the queen, just at a different risk level. Then both accounts would be too strongly correlated, and you'd build yourself a concentration risk. The point is to place different, ideally uncorrelated strategy portfolios on the different pieces. Honestly, where we stand today, right now we have 2 strategy portfolios, Portfolio S and Portfolio L. A portfolio that's built for higher risk from the ground up doesn't exist yet. So for now, you mainly run the safe core with Portfolio L and the pawns with Portfolio S. The full board with all the pieces needs more uncorrelated portfolios. Those are coming step by step, each with its own core idea. One of them will deliberately aim for higher risk, for example, and this is exactly where the circle closes back to account size. As your safe core grows, over time the middle pieces come in, and finally, the king with solid stocks and ETFs. In the end, the safe capital makes up roughly 60 to 80%, so you automatically become more conservative the larger the amounts get. And that's exactly how it should be. With a plan, not blindly. And that brings us to the core of it all. Higher risk doesn't mean blindly cranking up the leverage. Higher risk means playing deliberately and with clear rules. You decide in advance how much you're willing to lose, and you stick to it. And that's exactly where most people fail. Very few pull off the switch between high and low risk cleanly. Either they run too much risk everywhere, and then one bad stretch is enough for a huge loss, or they run too little everywhere, and then they choke their own potential. The chessboard method solves exactly this problem because high and low risk each have their own fixed place. That's exactly what our portfolios are built for. You can trade them at different risk levels. On the core account, you run them conservatively. On the pawn accounts, you turn the risk level up. So you get both out of the same system, and we don't stop there. Alongside the CFD portfolios, we now also offer stocks and ETFs. Our own stock tool is nearly ready. It connects directly to interactive brokers, with no trading view and no bridge in between. Futures aren't in yet, but they're coming by the end of the year, then also as futures-based portfolios. To close, two things on our own behalf. First, we're heading into a short summer break. We're taking the time to finish building the new portfolios in peace and to recharge. We've developed a huge amount lately and want to come back at full strength. For all members, support keeps running as normal during the summer break. We stay fully reachable. Only the videos here on the channel take a pause. Second, and this is important if you're thinking about a membership, on August 1st, we're raising the prices. Premium goes from $649 to $799, and Basic from $249 to $299. But whoever joins now locks in the current price for good. As long as you stay a member continuously, your entry price stays yours for all time. Whoever lets their membership lapse and comes back later pays the price that applies then. If you want to lock in the current price, now is the right moment. You'll find the link in the description. See you after the summer break.